All right, welcome to Talk Tickers. Today, we are deconstructing a stock move that was, frankly, just wild. We're talking about Designer Brands' third quarter report from December 9th, 2025. It sent some serious shockwaves through the market, and we're going to break down exactly how and, more importantly, why it all happened.
So right after their pre-market announcement, the stock just went vertical. I mean, it soared nearly 50% in a single day. For a retailer, that is an absolutely massive, almost unbelievable move. And that really brings us to the central mystery we're unpacking here. How on earth does that happen? We're going to get into how a company with sales that are actually declining managed to light a fire under its stock and trigger such a powerful rally. Okay, first things first, let's just look at the price action itself. This is where the story gets really, really dramatic. So check this out. The day before, the stock closed at $4.86. By the time the closing bell rang on earnings day, it was trading at $7.20. That's a gain of more than $2.30 a share, all in the span of just a few hours. Now, to understand what in the world drove that kind of move, we have to dig into the earnings report. And honestly, it presented a deeply conflicting picture for anyone trying to figure this company out. And here it is. This is the core paradox. On one hand, you've got revenue, the top line, which came in a little light, missing what analysts were expecting. But on the other hand, you have adjusted earnings per share, which didn't just beat expectations, it absolutely obliterated them by a staggering 111%. The market basically took one look at that massive bottom line beat and decided, revenue miss? What revenue miss? So let's dig into the numbers a bit more, right? You can see it here. Sales were down over 3% from the year before, and same-store sales were also negative. But look over to the right. Gross margin expanded by 210 basis points, which is just a fancy way to say 2.1 percentage points. And operating income jumped an incredible 87% year over year. That, my friends, is where the magic happened. So the crucial question is how? How do they pull off this massive profit beat while sales were actually falling? Well, the answer lies in management's very deliberate strategy, a strategy focused squarely on profitability, not just growth for growth's sake. And the CEO, Doug Howe, he framed it perfectly on the conference call. He presented the quarter not as some kind of happy accident, but as another successful step forward in their ongoing plan to completely reshape the business. Now this slide, this really shows the results of that strategy in black and white. Just look at the operating margin. It pretty much doubled from 2.9% to 5.7% in a single year. That is some powerful proof that they are getting much more efficient. And they did it by following a really clear playbook. They got super disciplined on costs and how much inventory they were holding. They stopped chasing unprofitable sales with deep discounts all the time. And they shifted their focus to their own higher margin brands. It was a classic case of prioritizing healthy profits over just big revenue numbers. And their guidance for the full year, it just hammers this exact message home. Management is basically telling Wall Street loud and clear, hey, expect our sales to stay a little soft, but also expect us to keep growing our operating income. The key message here is simple. We're going to grow earnings before we grow revenue. So that massive earnings beat was the fundamental spark that lit the fuse. But there was another incredibly powerful technical factor at play that acted like pure rocket fuel, a classic short squeeze. Now, for anyone who's not familiar, a short squeeze happens when a stock has a ton of people betting against it, that is, shorting it. When some surprisingly good news hits, the stock jumps higher, and all those short sellers are forced to frantically buy back shares to limit their losses. And of course, all that forced buying just pushes the stock price even higher, even faster. It's a vicious cycle. And heading into this earnings report, Designer Brands was an absolute powder keg, a staggering 57%. That's more than half of the company's entire tradable stock was sold short. This was an incredibly crowded bet against the company, and a very, very dangerous one. And this is the result. The moment that huge earnings beat hit the wire, all those shorts scrambled for the exits at the same time. Trading volume exploded to over 14 times the daily average as they were all forced to buy back shares at whatever price they could get. It poured gasoline on an already raging fire and sent the stock parabolic. So, with all of that drama behind us, what's our call on the stock from here? Where does it go now? Well, going forward, there are a few key things we're watching really closely. Can they keep these impressive margins if sales keep sliding? When will that top-line revenue number finally stabilize?
And a big one for us. Who are they going to name as the permanent CFO? And remember, all of this is happening against a pretty tough economic backdrop for consumer spending. So here's our prediction. In the next quarter, we expect to see more of the same. Really strong cost control, but continued pressure on sales. The stock price will probably be volatile as that short squeeze effect wears off, and we expect it to settle somewhere below that 720 high. So, balancing their excellent execution on one side against that very real sales risk on the other, that leads us to our final rating. Our rating on designer brands is market perform. Look, we are incredibly impressed by the operational turnaround and what they're doing with margins. They are controlling that brilliantly. However, that strength is balanced by the significant and ongoing risk from those negative sales trends and a tough environment for the consumer.
And as always, just a reminder, this is for informational purposes only and is not financial advice.